So you're seeing all the headlines about historic peace talks, right? But what are the financial markets, the actual money, telling us? Today, we're going to be detectives. We're diving deep into the Ukrainian and Russian markets to see what they're signaling about the future of this conflict. And we're going to unpack some truly mind-blowing data that suggests some big players knew exactly what was coming way before it ever happened.
All right, let's just start with this number, 263%. Just let that sink in. That is a massive, almost unbelievable rate of return. I mean, what on earth could possibly offer a yield that high? This number? Well, this is our first major clue in a really fascinating story. A story told not by headlines, but by the hard data.
Okay, so full disclosure, this whole thing got kind of personal for me. I saw that number and I thought, wow, okay, that's an appealing buy. I did some quick bond math in my head, and I figured, a yield over 250% on a one-year government bond, that's a risk I'm willing to take. So I tried to buy it, and I couldn't. Not a single brokerage, not even my own bank, would touch it. And honestly, that rejection is what kicked off this entire investigation.
So yeah, that astonishing rate, that 263%, that was the yield on a one-year Ukrainian government bond right after the invasion started back in February 2022. A yield that high, it just signals extreme risk and, frankly, desperation. It's the kind of return you see when a market is literally screaming for cash, and it really sets the stage for everything else we're about to uncover.
So what does Ukraine's bond market even look like today? Well, in a nutshell, it's defined by just incredible volatility and ridiculously high interest rates. And what's really crucial here is that there's almost no long-term debt. It's all short-term paper. This is basically payday financing, but for a government, a huge sign of immense short-term pressure just to keep the lights on.
That desperation we just talked about, that's our first clue. But our next piece of evidence is even bigger. And honestly, it's a potential smoking gun. We're talking about the yield curve. For market detectives like us, the shape of this curve is one of the most powerful signals out there of fear and uncertainty about what's coming next.
So what is an inverted yield curve? Okay, think about it like this. Normally, you'd expect to get a better interest rate for locking your money up for 30 years than for just 1 year, right? Well, an inverted curve flips that completely on its head. It's when that one-year loan is suddenly more expensive than the 30-year one. It signals that investors are absolutely terrified about the immediate future, like the next 12 months, way more than they are about the next 20 or 30 years.
And this is where our investigation takes a really interesting turn. While Ukraine's curve inverted, right when the war began, Russia's yield curve inverted all the way back in October of 2021. That's 4 full months before the official start of the conflict. It's just a powerful indicator that the bond market was sensing some serious short-term trouble way off on the horizon.
Okay, so the bond market was flashing this huge warning sign months in advance. But did the currency market see it too? Well, that's our next set of clues, and let me tell you, they paint a dramatic picture about economic stability and, just raw purchasing power.
And when you look at the currencies side by side, the difference is just stark. Since February 2022, the Ukrainian hryvnia has weakened by a whopping 30% against the US dollar. The Russian ruble, on the other hand, despite all that crazy volatility at the start of the war, has only weakened by about 4%. That's a huge divergence that points to two very, very different economic realities. But, to get a real sense of lost purchasing power, we need to measure it against something stable, something like gold. And when we do that, the story becomes even clearer. The price of gold in Ukrainian hryvnia has shot up 164%, while in Russian rubles, it's up 93%. I mean, what currencies have been devalued for sure, but the impact on Ukraine has been just far, far more severe.
Okay, so we've seen fear in the bond markets, we've seen divergence in the currencies. Our investigation now turns to our next clue, the stock markets. And the contrast here, well, it's maybe the most dramatic of all, especially when we look at the days leading up to the conflict.
So first, let's just cover the basics. The Russian stock market, it's open, it's trading, and it's actually up 18% in US dollar terms since January 2022. The Ukrainian stock market, on the other hand, is effectively halted. There's just no real trading happening. One market is functioning, the other is completely frozen.
Now, this timeline, this is where the evidence just becomes undeniable. Look at what was happening in the Russian market. Back in October 2021, the very same month the yield curve inverted, we see above-average selling.
Then in January, something called harmonic selling starts. Now that is not random panic, it's coordinated rhythmic selling. It's the kind of footprint that huge players leave when they are methodically getting out of the market. They were unloading massive positions, day after day, right up until the invasion. It is really hard to look at this data and not conclude that somebody knew what was coming. So the clues from before the war are pretty clear. But our investigation isn't just about the past. What are these same markets signaling now? This is where all the evidence comes together to give us a verdict on what might be coming next.
All right, the most crucial point right now is this. After being inverted for most of the war, Russia's yield curve is now doing the exact opposite. It's uninverting and steepening. It's returning to a more normal shape. This is the single most important forward-looking signal in all of this data.
So why does that matter so much? Well, because a steepening yield curve like this signals a very specific chain of events. It means the bond market is betting that the war, or at least the wartime economy, is going to wind down. That would cause inflation to fall, which would then allow the central banks to start cutting its very high interest rates. The market is pricing in a return to normal.
But here's the twist. Just saying the curve is steepening doesn't actually tell the whole story. We have to look at how it's steepening. Is it happening because things are getting better, or because they're getting worse? The answer to that question reveals everything. And this is where we see the crucial difference. Russia's experiencing what's called a bull steepener. That's when yields are falling, especially on those short-term bonds. This is a classic bullish sign because it means the market expects the central bank to cut interest rates soon, which signals confidence. The US, by contrast, has a bear steepener, where rates are rising, signaling uncertainty. The signals could not be more opposite.
So what's the final verdict from the markets? Well, for the last 8 to 9 months, investors have been consistently buying Russian government bonds, especially the short-term ones. This isn't just a guess. It's classic market behavior that prices in lower inflation, a cycle of interest rate cuts, and an end to the wartime economy.
You know, from those early warning signs way back in late 2021 to the bullish signals we're seeing today, the collective wisdom of the market seems to have a pretty clear point of view. It really appears to be betting on normalization and a move towards peace. The ultimate question, of course, is whether that bet is going to pay off.